Welcome to my channel, people. In this video, we would be talking about investments, and I will also be giving you a brief description about the types of investments. So here we go. The first point is investment. What is an investment? An investment is actually a process in which we allocate money into an asset in the hope that its value will increase in future. There are two prime goals to invest. One is in future, either you want to generate cash flow from that asset or you want to generate a huge profit by selling it. So no one invests to incur a loss. Everyone is willing to get profit either from cash flow, either from selling it. Now we'll be coming towards the types of investments. So if we talk about investments, we have broadly two types of investments. One is a financial investment and the second is a physical investment. When we talk about physical investments, it is something we have always heard from our parents in India. Like when we were kids, what was the main investment that our parents were talking about? Real estate. Everyone used to say, okay, if you want to invest something, buy some property. It will increase in value and then you will be able to generate cash flow through rent or you will be able to sell it. In turn, helping you in future. So this is a prime investment which used to be given in advice to us by our parents when we were kids. Or this was like a trend. I know in 1990s it was a trend, like investing in real estate. Now the main question is how real estate is a physical investment and how it is different from financial investments. So real estate has a physical significance. That is why it is known as a physical investment. On the other hand, there is gold, there is silver, all the commodities are in physical investments. But when I talk about financial investments, I'm talking about an investment in which is written on paper, which has a physical, which doesn't have a physical value, but it has a paper value. That it is written on the paper. Okay, this belongs to you. This has this much of value, and you will be able to dematerialize it when you want. So there are different type of financial instruments or financial assets which we could talk about. The first one and the most important and the simplest one is a savings bank account. We get interest out of it. Second is recurring deposit. We also get interest. Third is public provident fund. We also get interest from it. Fourth is one of the most important but underrated scheme, that is the post office scheme. Fifth, bonds and debentures in India. And the sixth one, though I would be telling that it is the last one because I cannot consider all those instruments in one video. The last one would be equity. So we'll start with the savings bank account. So if we talk about a savings bank account, it is known as the first investment scheme that that in India we were ever advised to take. So what is actually a savings bank account? It is an account with a bank in which you get a certain amount of interest if you keep money there for 1 year. For example, in SBI we get around 3%. For example, if you have 1 lakh deposit in your bank account in SBI, you will be getting 3,000 rupees per year. I'm actually not sure that it's 3,000, 3.5 or 4 or 3, but once I was getting 3,000 rupees. I had 1 lakh, so I was getting 3,000 rupees per annum. So after 1 year, my account balance was actually 1,03,000 instead of 1 lakh. On the other hand, if I talk about recurring deposit, it is a very good scheme in which we have to allocate money every single month and it is locked in, and after the maturity date we get certain amount of interest. It is actually around 6%, 6 to 7% in banks in India. They are guided by banks, and it is a very low risk investment. On the other hand, if I talk about savings bank and recurring deposit, they are short term to medium term investments. Like it will be there for one year, 6 months, 1 year. You can also go for it in 2 years, but the return is not that good as compared to the other financial assets that we'll be talking about. The third one is actually the post office scheme. The post office scheme is one of the best investments that you can make, but it has a medium term investment. Like there's a lock-in period of 6 years. Like when it gets matured, you can get your money out. The maximum limit for it is 4.5 lakhs for a single person to deposit, the maximum limit, and for a joint account it is around 9 lakh rupees. So, and the minimum value from which we can start the scheme is 1,500 rupees per month. So it is also a good investment. It provides an interest rate about 7.8%. On the other hand, then we have public provident funds. Public provident funds are actually extremely famous with the job class group in India, because from our salaries, PPF is actually deducted every single time. So the minimum value of a PPF is around 500 rupees, and it is generally for long term only, for 15 years, I guess, or more than that as well. And we get a return of around 7 to 8% from PPF. It's one of the best schemes if you're thinking of long term and you want to be risk free. Like, it is a very low risk investment. You can be extremely risk free in this fund. On the other hand, then comes debt instrument, that is bond. Now, a bond is a different thing. People actually don't know about it in India. Like, the people who are from non-commerce background, they don't know what bonds and what are debentures, what are bonds. So I'll be talking about in brief about it, and would be able to explain it. I will try my best to explain it. So what is a bond? A bond is actually a debt instrument. What is a debt instrument? Whenever you are lending money to someone and saying, okay, provide me the principal with the interest rate after some time, you're actually using a debt instrument. Now, in financial world, when you pay someone some amount of money and you demand interest and the principal after some time, this is called the regulation of debt market. So in India, there are different schemes. Like, you can provide debt to a company. It will be called a debenture. You can also provide a debt to the government. It will be called a bond. So what government and what companies do, companies will tell you, okay, you have provided us this amount of money, like let's say 20 lakh rupees. You provided 20 lakh rupees to a ABC company, and they said, okay, it has our debenture has a maturity date of 2 years, and after 2 years we will be giving an interest rate of 10% per annum or 8% per annum, and some like anything like that. So we will be getting that much amount of money on that. So if you provided 20 lakh rupees to that debenture, and they provided you an interest rate of 10%, let's say. So in 1 year, your investment would be 22 lakh rupees. Like, it will grow 22 lakh rupees from 20 lakhs. On the other hand, in the next year, in the consecutive year, it will grow to 22 lakh 20,000 rupees, which means on an average, after 2 years, you will have 24 lakh 20,000 rupees in your bank account. In a span of 2 years, it grew to 24 lakh 20,000 rupees. So this is a debt instrument. On the other hand, this also happens with government as well. Governments do issue bonds. They also provide us an opportunity that we can invest in those bonds, and they will be providing us a specified amount of interest rate by the end of that maturity date, by the end of the bond life. Now, the main thing we have to consider is they are extremely low risk investments. Why? Because these companies, they cannot shut down easily. Like, it's very difficult for a company to shut down. We have seen, like, government gives a lot of chances for a company to run. On the other hand, if we talk about government itself, government is actually a very, very low risk investment. You are providing money to the government and they're generating revenue. They will be providing you money back in every single way they can. Then, though, there is some risk in this as well. So at the last, we'll be coming to equity and shares. Now, explaining and introduction to equity is a different thing for a person who's from non-commerce background. So I'll be covering a very small concept, like what is equity capital. So let's say a company is has been working for 5 years, and now it thinks, okay, I need to generate more money because I need to have more capital through which I could do more business, have a huge client base, and would be able to generate more revenue. So what it will do, it will go public. Now, what does it mean when a company goes public? When a company goes public, it gets registered on the stock exchange, and people are actually there to buy the share of that company. When someone buys share of that company, they're increasing the equity capital of the company. So if you're providing money to a company, you're saying, okay, your share is for, let's say, 20 rupees. I think your company is working really well, and in 2 years or 3 years, if I provided this much amount of money, I think, and a lot of people are doing that, the value of the company will increase, and they are very good with working. So in 2 years, what happens? The share climbs to, let's say, 100 rupees. You bought it at 20, now it is 100. Your investment has been quadrupled. You bought it for 20,000, now it has a value of 1 lakh rupees. So this is what happens in investment. This is what happens in equity. So in equity shares, we have to understand one very important thing, that the companies that are there, they're using that capital to generate their own business themes. That capital will be used, and it will be there to make sure that the company is working and it is in a very good condition. Okay, are you getting it? I think I confused you in some way. So, in a simple manner, the equity share concept is actually you're having a part in the company, though you're not actually the board in the board of board of directors of the company, but you also have a part of the company, that if that company works really well, you'll be getting benefit from it. On the other hand, if it goes down, if it is not working well, you will be affected. So equity is actually a high risk and high reward market. You can go into equity. I have seen shares of companies which have extreme volatility. They go from 100 to 200 in a week. They go from 75 to 200 in a week. And I have seen shares which go from 1400 to 500 in 1 week, in 2 weeks. Are you getting it? So that's it. So these were the basic and broad categories of investments that I had to talk about. So these 6 categories, and out of these 6 categories, I will be giving more attention to stock market, like equity market and debt instrument, in my coming videos. I would be trying to make you understand how these markets work and how actually one can get benefited from them. Okay, I believe now you were able to understand some of the concepts from a video, and if that happened, I'm extremely glad for that. Thank you for watching. I'll be coming back with next video and would be willing to provide knowledge as I want to. Thank you for watching.